Right, welcome back. Now, our next guest actually runs Anand Rathi Wealth, and that's as, of course, you look at the markets, at live pictures there out of Mumbai, and just a couple of minutes to the open. I mean, this market's really just gone berserk this year, really punching above its, I wouldn't say punching above its weight, but really punching above everyone. Our next guest, of course, oversees $4 billion in assets under management. They're with us now to discuss their strategy and really how you navigate this, given that it has really already outperformed quite a bit. Deputy CEO Feroze Azeez joining us right now. I'll leave it there and I'll keep it very simple. Where does this market go next year, Feroze?
David, if you look at the market, and like you rightly said, it's outperformed significantly vis-a-vis most of the markets from a peer-to-peer comparison perspective. If you look at the earnings of Indian corporates, that's doubled as well. It went up from 470 rupees on the Nifty earnings to close to about 840, which is what we expect to close this year. So coming back to your pointed question, where do we see this? I think 12-14% further growth on the indices is very much likely because the earnings on both these important indices, which is the large cap, which is Nifty, is what we track, which is top 50 companies, is expected to be 950 rupees next year. That means a 20 earnings multiple. The historical average is about 18. We are a little above the historical averages, so little frothy. But I think a 12, 14% Indian rupee return and about 3% dollar depreciation, which is the historical 15-year average, is what one should look at from a dollar standpoint.
Understood. And to your point, perhaps what part of what you were just saying there or alluding to was, I mean, this market can remain expensive and remain elevated really as far as multiples are concerned. So could you talk a little bit more about the multiples that you are expecting? Because we are trading, I think, at one standard deviation above historical mean. Do we get multiple expansion, or do you think earnings really come through in a big way?
So if you look at the historical data of the last 22 years and try and normalize it to interest rates, I think this is still fair valuation because historical averages of 18 multiple from forward is something which is interest rate neutral. If you normalize it to interest rates, we are marginally lower than the historical average interest rate. So 20 forward is possible. From a year-on-year perspective, we are at 23 kind of price to earning multiple. That's a little elevated. So we at Anand Rathi compute the froth in the market, and that's about 3% froth. So can it trade at valuations? I think definitely yes. If you look at other valuation parameters, now, for example, the historical average between the market cap to GDP ratio is 0.9. For India, or 90%. Today it's at 100%, whereas the US historical average market valuations to GDP is 1.4, but it's at 1.7. So I personally think it's not very expensive, and earnings will substantiate these valuations and sustain them for reasonably long periods of time.
Feroze, given toppy valuations, however you look at it, and given expectations of volatility in 2023, does it make sense for investors to switch to the fixed income market given where yields are right now?
Yes, Linda, I think it's a very valid observation. To my mind, yes, moving some portions of the money to the debt side is also very lucrative because Indian debt is at 7.2, 7.3 on a 10-year paper, sovereign central government paper, which I think is very attractive. And India also has a lot of tax advantages from a debt standpoint. So I think that's attractive. But if you look at the equity side, moving money out of equity is also going to be very specific because India still has a large potential to generate alpha over indices. Now, for example, Anand Rathi recommends active portfolio, which has outperformed the Nifty by about 3.2% over the last 8-9 years. That's a huge opportunity in India, which becomes very difficult to get that extra return in developed markets.
How are you assessing risk? Because even when it comes to growth, there are risks out there. We had Raghuram Rajan, the former RBI governor, saying that even 5% will be difficult for India to achieve when right now the government is looking at 6-7% growth for 2023.
See, if you look at how we are poised from an economic standpoint, after the downgrade, we are still looking at this year to close at 6.8% growth in real terms. Point one. Point two, I think our tax collections are a great evidence and a good lead indicator to where we would end. The indirect tax collection has gone up 27%. Direct tax collection is close to about 23% growth in direct tax collection. If you look at the fiscal prudence, we have only penetrated 46% in 7 months in terms of our expenditure. So government is looking at 3 lakh crore extra in Indian rupees from the budgeted number. So I think the government spending will give that push to the growth. That's one positive. Of course, there are several uncertainties as well. But I think for a long-term investor, equities would be something which he should, if not overweight, at least be neutral to a strategic allocation.
Right, and Feroze, you mentioned active management, which I guess alludes to the fact that you don't simply just buy the index. What's your favorite sector? If you could tell us a specific name, that would be great as far as a specific stock. And what would you be avoiding as well?
See, I think we would definitely look at banking and financial services sector because there's an inherent growth in several businesses because of cost of time. For example, asset management businesses, wealth management businesses have an inherent implied growth. Embedded one because of the growth in their assets just by the virtue of time and the India story, and then growing that business at 20-25% when you know 10-12% growth comes by the virtue of time passing. Those are one sector, one specific asset management industry. Now we have about 5-6 listed stocks. That's something which we think is going to do well. Manufacturing, which with the PLI scheme, is something which we are very strongly believing that it can give us the push. And manufacturing and I think the consumer sentiment, the rural demand in India has been reasonably low over the last 1-2 years. If you look at initial signs, that seems to be picking up. So if you have to be a little ahead of the curve, consumption is another theme. These are the 3 themes if somebody has to play. Of course, the global dependency, there are several sectors which are globally dependent. I think we're staying away from that till there's more clarity which is emerging from the emerging markets.
Feroze, final question. Top themes for 2023?
I think, like I said, Linda, we would definitely look at financial services as one of the best themes because there is a huge potential. In spite of its overweight, its high weight in the index, it still has the potential of generating alpha. So I think that's the theme we're going for.
All right. Feroze Azeez, Deputy CEO at Anand Rathi Wealth. Thank you so much for your time today. India's been trading for a couple of minutes now. Let's do a check on where they are right now.